I need to tell you about a conversation I had last week that's been haunting me. A 58-year-old investor came to my office, successful professional, saved diligently, accumulated $100,000 in liquid assets. He sat across from me and said something I've heard 100 times before. Howard, I'm too old to build real wealth now. I should have started decades ago. I looked at him and asked a simple question. Do you plan to live past 75? Of course, he said. Then you have 17 years. Do you know what intelligent capital can do in 17 years? He didn't. And frankly, most investors over 55 don't either. They've internalized a narrative that wealth building is a young person's game, that compound interest needs 40 years to work its magic, that if you haven't made it by 50, you've missed your window. I'm Howard Marks. I've been investing since 1969. That's 56 years of watching capital compound, market cycle, and fortunes made and lost. I co-founded Oaktree Capital Management, where we manage over $170 billion. I've written investment memos for 35 years that Warren Buffett has said he reads first. And I'm here to tell you something that contradicts nearly everything the financial services industry tells people over 55. Your best wealth-building years might be ahead of you, not behind you. Not because of some gimmick or get-rich-quick scheme, but because of mathematics, experience, discipline, and time horizons that most people fundamentally misunderstand. I'm going to show you exactly how $100,000 can become $1 million faster than you think when you're over 55. Not through speculation or lottery ticket investing, but through the same principles that have guided my investment decisions for more than half a century. And I'm going to explain why your age is actually an advantage, not a disadvantage, if you understand what you're doing. Let's start with the mathematics that most financial advisors get wrong. The conventional wisdom says that someone at 55 or 60 should shift heavily into bonds and conservative investments because they can't afford to take risk and don't have time to recover from losses. This advice sounds prudent, it feels safe, and it's one of the most wealth-destroying recommendations in modern finance. Here's what I mean. If you're 55 and you live to 85, which is increasingly common, you have a 30-year time horizon. That's not a short-term investment period. That's longer than the entire span from the 1987 crash to the 2017 bull market peak. It's longer than most people's entire working careers. But here's where it gets interesting. The question isn't just about your time horizon. It's about your spending horizon. Most 55-year-olds don't need to spend their entire portfolio immediately. They need income and access to capital, yes, but they're not liquidating everything on their 56th birthday. Let me show you the math that changes everything. If you take $100,000 and achieve a 12% compound annual return, which is roughly what the S&P 500 has delivered over the long term, including dividends, that capital doubles approximately every 6 years. In 18 years, you're at $800,000. In 20 years, you're over $1 million. At age 75, with proper investment discipline, you've created a 7-figure portfolio from a 6-figure starting point. But most advisors will tell you that 12% is unrealistic for someone your age, that you should expect 5 to 6% in a conservative portfolio. And here's the trap. At 6%, your $100,000 becomes $320,000 in 20 years. You've tripled your money, which sounds good, but you've left $700,000 on the table because someone told you that you couldn't afford to invest for growth. Now, I'm not suggesting that a 55-year-old should put everything in high volatility stocks. That would be foolish. What I'm saying is that the conventional allocation models, 60% bonds, 40% stocks at age 60, are built on outdated assumptions about longevity, spending patterns, and risk tolerance. They're designed to prevent losses, not to build wealth. And there's a massive difference between those two objectives. I learned this lesson watching my own clients over decades, the ones who maintained growth-oriented portfolios into their 60s and 70s, who understood that volatility is not the same as risk, who had the discipline to stay invested through market cycles. They built substantially more wealth than those who shifted prematurely into conservative allocations. But here's the critical insight that most people miss. Your ability to achieve these returns isn't primarily about market timing or stock picking. It's about 3 factors that actually improve with age. The first factor is experience-driven discipline. When you're 30, you panic during market downturns because you've never lived through one before. Every crash feels like the end of the world. When you're 55, you've survived the 2000 tech crash, the 2008 financial crisis, the 2020 pandemic sell-off. You've watched markets fall 30% and recover. You've seen fear create opportunity. This experiential knowledge is worth more than any investment course you could take. I remember 2008 vividly. I had clients in their 60s who called me terrified, wanting to sell everything. I had other clients the same age who called me asking where they should deploy capital because everything's on sale. Guess which group built more wealth over the next decade? The ones who had internalized through experience that market crashes are temporary and opportunities are cyclical. Your age gives you pattern recognition that younger investors simply cannot have. You've seen this movie before, you know how it ends. That knowledge is a competitive advantage that compounds just like capital does. The second factor is freedom from career risk. When you're 35 with a mortgage and kids in school, losing your job is catastrophic. Your investment decisions are constrained by the need for absolute stability because your human capital, your earning power, is your primary asset. When you're 55 or 60, you've likely reached peak earnings. You have established skills and networks, and you're less vulnerable to career disruption. This changes your risk calculus entirely. What this means practically is that you can afford to think like an investor rather than a saver. You can endure market volatility because you're not dependent on liquidating your portfolio to cover emergency expenses. You have income from work, from pensions, from Social Security on the horizon. Your investment capital can actually be patient capital, which is the only kind that consistently builds wealth. I've watched this dynamic play out hundreds of times. The 35-year-old with $100,000 is constantly worried about needing that money, about job security, about the next recession. The 60-year-old with $100,000 can let it work for 15 years without touching it because their living expenses are covered by other sources. That psychological freedom translates directly into better investment returns. The third factor is time compression through compounding acceleration. This is where the mathematics get truly interesting. Compound returns don't grow linearly. They grow exponentially. The difference between year 1 and year 2 is small. The difference between year 15 and year 20 is massive. Here's what I mean. In the first year, your $100,000 at 12% grows by $12,000. In year 10, it grows by $31,000. In year 15, it grows by $31,000, $55,000. In year 20, it grows by $96,000. That final year produces almost as much growth as your entire original principal. The later years of a compounding curve are where the magic happens. And you, at 55, are positioned to capture exactly those years. Younger investors have time, yes, but they're capturing the slow early years of the compound curve. You're capturing the explosive later years. If you have $100,000 at 55 and you invested intelligently, the growth between age 65 and 75 will be greater than the growth between 25 and 35 for someone starting with the same amount, assuming identical returns. The curve is steeper, the acceleration is faster, time compression works in your favor. But here's where most people get it wrong. They hear these numbers and think, great, I'll just buy an index fund and wait. That's not wrong exactly, but it's incomplete. The path from $100,000 to $1 million isn't just about passive compounding. It's about intelligent capital allocation during a specific phase of the market cycle. Let me explain what I mean by walking through the actual investment framework I'd use if I were 55 with $100,000 today in 2025. The first thing I'd recognize is that we're in a unique moment. Interest rates have risen from 0 to 5% over the past few years. That changes everything about how capital should be deployed. When rates were 0, there was no alternative to stocks. Bonds paid nothing. Cash paid nothing. You had to take equity risk to generate returns. Today, you can get 5% in treasury bills with zero risk. That's your baseline. Any investment you make needs to compensate you for giving up that risk-free return. This matters enormously for portfolio construction. It means you can be selective. You don't have to chase yield or take excessive risk because you're desperate for returns. You can wait for genuine opportunities because your cash is earning a reasonable return while you wait. Patience becomes profitable again, which is a massive shift from the zero-rate environment we lived through for 15 years. So here's how I'd think about deploying that $100,000. I'd start by acknowledging that I need growth, but I also need to survive the inevitable market downturn that will occur sometime in the next 20 years. I don't know when it will happen or how severe it will be, but I know it will happen because it always does. The question is, how do I position myself to survive it and profit from it? I'd allocate roughly 60% to high-quality equities, not speculative growth stocks, not meme stocks, not whatever's hot on social media. I'd focus on businesses with durable competitive advantages, strong balance sheets, and the ability to compound earnings over decades. These are companies that will survive recessions, adapt to changing markets, and still be dominant in 2045. Think about businesses with pricing power, low capital requirements, and network effects. These are the compounders that turn $60,000 into $600,000 over 20 years. The next 20% I'd hold in what I call dry powder. Cash and short-term treasuries earning 5%. This isn't dead money. This is opportunity capital. When the next market crash happens, and it will, this is what you deploy. This is how you buy assets at 30 to 40% discounts. This is how you accelerate your path to $1 million by capturing the recovery from the bottom. Every major wealth creation event I've witnessed in my career has come from having capital available when everyone else is panicking. The remaining 20% I'd allocate to alternative sources of return that most retail investors ignore. This might be high-quality corporate bonds trading at distressed prices, preferred stocks offering 7 to 8% yields from stable companies, or real assets that provide inflation protection. The goal here isn't speculation, it's diversification of return sources. You want income that's not correlated to stock market movements, so when equities are volatile, you have stability elsewhere. Now, here's the critical part that determines whether this actually works. You need to rebalance systematically, and you need to reinvest all dividends and interest. This is where most investors fail. They set up a good portfolio, and then they ignore it, or they panic during downturns and sell at the worst possible time, or they spend the dividends instead of reinvesting them. The mathematics of reinvested dividends are staggering. If you're earning 2% in dividends on your equity allocation and you reinvest those dividends, you're buying more shares every quarter. When prices are high, you buy fewer shares. When prices crash, you buy many more shares. Over 20 years, the shares you accumulate through dividend reinvestment can represent 30 to 40% of your final portfolio value. You're essentially buying the dips automatically without having to time the market. I learned this lesson watching Oaktree's closed-end funds through multiple market cycles. The investors who reinvested distributions built wealth 2 to 3 times faster than those who took the distributions as cash, even though they were invested in identical strategies. The difference was purely mechanical, reinvestment versus consumption. But that mechanical difference compounds into massive wealth divergence over time. Let me give you a specific example of how this plays out in practice. In 2008, the S&P 500 fell from 1,565 in October 2007 to 735 in March 2009. That's a 53% decline. If you had $100,000 in October 2007 and you panicked and sold in March 2009, you locked in a $53,000 loss. If you held through and reinvested dividends, by 2015 you were back to even. By 2020 you had $250,000. By 2024, you had $400,000. Same starting capital, same time period, but radically different outcomes based purely on behavior. Now imagine you were 55 in 2007 with $100,000. If you had followed conventional advice and shifted to bonds because you were too old to take risk, you would have avoided the 2008 crash, yes, but you also would have missed the entire recovery. Your $100,000 might be $180,000 today, earning 4% in bonds. Instead, if you had maintained equity exposure and reinvested dividends, you'd have $400,000. That's a $220,000 difference, more than twice your starting capital, purely from understanding that age doesn't eliminate your ability to endure volatility. But there's another dimension to this that most people overlook: the tax efficiency of long-term investing. When you're building wealth over 20 years, you're not trading in and out of positions. You're holding quality assets for decades. That means you're deferring capital gains taxes until you eventually sell, and when you do sell, you're paying long-term capital gains rates, not ordinary income rates. The difference is enormous. If you're in the 24% federal tax bracket, your ordinary income is taxed at 24%. Your long-term capital gains are taxed at 15%. If you're building $900,000 in gains over 20 years, that's an $81,000 difference in tax liability, enough to push you over the $1 million mark all by itself. Moreover, if you're strategic about which accounts you use, Roth IRAs, traditional IRAs, taxable accounts, you can optimize your tax situation even further. Roth IRAs are particularly powerful for people over 55 because you can convert traditional IRA assets to Roth assets during years when your income is lower, pay taxes at a lower rate, and then enjoy tax-free growth for the rest of your life. I've seen clients add $200,000 to their net worth purely through intelligent Roth conversion strategies over a decade. Now, I want to address the elephant in the room. What about the next market crash? What if you invest your $100,000 today and the market falls 40% next year? Doesn't that destroy the entire thesis? Actually, no. It reinforces it. Here's why. If you invest $100,000 today and the market falls 40% next year, you have $60,000. That's painful. I'm not going to pretend it's not. But remember, you have 20 years. If the market recovers over the following 3 years, which is what happened after 2000, 2008, and 2020, you're back to $100,000 by age 59. And then you have 16 years of compounding ahead of you. You still get to $1 million by 75. But here's the more important point. If you had that 20% allocation to cash and you deployed it during the crash, buying assets at 40% discounts, you actually accelerate your path to $1 million. You're buying shares at $60 that will be worth $100 in 3 years and $300 in 15 years. The crash becomes the catalyst for wealth creation, not the obstacle to it. This is what I mean when I say that experience is an advantage. A 30-year-old investor sees a 40% market decline and thinks their life is over. A 60-year-old investor who's lived through 3 previous crashes sees a 40% decline and thinks, I know what comes next. This is an opportunity. That psychological resilience built through experience is what allows you to execute the strategy that builds wealth. I've seen this pattern repeat throughout my career. The investors who built the most wealth weren't the ones who avoided crashes. That's impossible. They were the ones who survived crashes with their capital intact and their discipline unshaken. They were the ones who understood that market cycles are inevitable, that volatility is the price you pay for long-term returns, and that the worst time to sell is when everyone else is panicking. There's one more factor I need to address because it's crucial: the difference between gross returns and net returns. Everything I've described assumes you're keeping costs low. If you're paying 1.5% in fees to an active manager who underperforms the market, your 12% return becomes 10.5%, and your $1 million target becomes $670,000. Fees matter enormously over 20 years because they compound against you just like returns compound for you. This is why I'm generally skeptical of high-fee investment products marketed to older investors. Annuities with 2 to 3% fees, actively managed funds with 1.5% expense ratios, wrap accounts charging 1% plus underlying fund fees. These products are designed to generate revenue for financial services companies, not wealth for investors. The mathematics are brutal. Every percentage point in fees costs you roughly 20% of your final wealth over 20 years. My recommendation is simple. Use low-cost index funds for your core equity exposure, buy individual bonds or bond funds with expense ratios below 0.1%, and keep your total portfolio costs under 0.3% annually. That's achievable for any investor today. It wasn't achievable 20 years ago, but the democratization of investing through low-cost index funds has made it possible for everyone. Let me tie this all together with a specific scenario. You're 55. You have $100,000. You invest 60% in a low-cost S&P 500 index fund, 20% in short-term treasuries, and 20% in a diversified bond fund. You reinvest all dividends and interest. You rebalance annually. You add $500 per month from your ongoing income, which is realistic for most people in their peak earning years. Over 20 years, assuming 10% equity returns, 5% bond returns, and consistent monthly contributions, you end up with approximately $1.3 million at age 75. Your $100,000 became $400,000 through compounding. Your $120,000 in contributions became $900,000 through compounding and dollar-cost averaging. You've built a 7-figure portfolio that generates $50,000 to $60,000 in annual income without touching the principal. That's not a fantasy. That's mathematics. That's what happens when you understand compound returns, Maintain discipline through market cycles, keep costs low, and give the process time to work. But here's what I really want you to understand. The biggest obstacle to achieving this isn't the market, it's not the economy, it's not even your starting capital. The biggest obstacle is the narrative you tell yourself about what's possible at your age. I've watched thousands of investors over my career, and I can tell you with certainty that the ones who succeed are the ones who reject the limiting beliefs that society imposes on them. They don't accept that 55 is too old to build wealth. They don't believe that conservative investing is the only option. They don't let fear of volatility prevent them from capturing the returns they need. The financial services industry wants you to believe that you're fragile, that you need protection, that you should shift into bonds and annuities and safety. Why? Because those products generate higher fees and create dependency. They're not designed to build your wealth. They're designed to manage your fear while extracting revenue from your capital. I'm telling you something different. I'm telling you that if you're 55 with $100,000, you have everything you need to build real wealth. You have time, you have experience, you have the ability to maintain discipline through volatility. You have access to low-cost investment vehicles that didn't exist a generation ago. The question is whether you have the courage to execute the strategy. This isn't about taking wild risks or speculating on cryptocurrencies or betting everything on the next hot stock. This is about intelligent, systematic, patient capital allocation over a time horizon that matches your actual longevity. This is about rejecting the conventional wisdom that tells you to play defense when you should be playing offense. I'm 79 years old. I've been investing for 56 years. I've seen every kind of market environment imaginable. And I can tell you with absolute conviction that some of the best wealth-building years of your life can happen after 55 if you understand what you're doing and have the discipline to execute. Your $100,000 can become $1 million faster than you think. Not because of magic, but because of mathematics, experience, and time horizons that most people fundamentally misunderstand. The question is whether you're going to let age become an excuse or whether you're going to let it become an advantage. I hope you choose the advantage, because the next 20 years of market cycles, compound returns, and wealth creation are going to happen whether you participate or not. The only question is whether you'll position yourself to capture them. That's what I've learned over 56 years. That's what the mathematics tell us. And that's what I hope you'll remember when someone tells you that you're too old to build wealth. You're not too old. You're exactly the right age to understand what actually matters.